Is the US stock market currently in a bubble? Well, we're going to answer that question conclusively today by looking at some simple metrics and charts that will give us a very well-rounded and rational view of where we are in the current market cycle. This metric that I'm going to be sharing with you guys today and we're going to be diving into is actually coined after the legendary investor Warren Buffett. And it has a long track history, and it really is amazing to study over a little bit. And it's very simplistic and very intuitive. So we're going to be looking into this today. And I think after watching this video, I think you'll have a more grounded perspective of where we are, because it's very easy to get lost in the insanity of what's happening right now in financial markets and, the rest of the world as well. So without further ado, let's get right into this video. All right, so here is the Buffett indicator. This can be found off gurufocus.com. I'll put the link in the description below of this website so you guys can check it out yourself and see how things change over time. But first, what we're going to do is check out this chart right here, and it shows the three different inputs that go into these metrics and how we can kind of conceptualize the market at its current state. So the first input that we have here, this first line that's soaring to the top of this chart in blue, is the Wilshire Total Market Index, also known as the Wilshire 5000 Index. And this index basically takes into account all of the US stocks and gives a complete valuation of the US stock market. So you have the S&P 500, you have the NASDAQ, you have the Russell 2000, you have all these different indexes that take into account different kinds of companies or whatnot, or large companies, small companies, and whatnot, tech companies in the NASDAQ. This index basically takes them all and gives you a total valuation, let's say, of the US stock market. The green line here is GDP, or gross domestic product, which takes into account all the goods and services that are created in a given year in the US. And so this kind of gives you a good proxy of the total wealth of the United States. And then here in red, this is a new input that this Buffett indicator site has added, is the total assets on the Federal Reserve balance sheet. So this gives us some different kinds of perspectives and different kinds of calculations that we can input given the increase in the amount of activity of the Federal Reserve in the last 10 years, but even so in the last year and a half. So now let's check out this chart over here. This gives us two different ratios. And this is looking at the last 20 years. Let's go ahead and just take it at the last 10 years. It'll be a little less activity. So we've got two measurements right here. The green line is the total market cap. So the entire, the whole value of the US stock market divided by gross domestic product, GDP. And so you can kind of think of this as how valuable is the total US stock market compared to all the goods and services that the United States is creating. Ideally, you would think they would be somewhat similar. But right now, that number is at 209.7%, which basically means that the US stock market is currently valued at over double of that of which the US is actually creating in goods and services per year. So that's pretty wild on its face, right? And this blue line right here is the adjusted figure that also adds in the denominator the total assets of the Federal Reserve. And so this is the total market cap, the total US stock market divided by gross domestic product plus all the assets on the Federal Reserve balance sheet. This is currently at 153.1%, which is also a high on this chart. So both of these figures are going up, but one figure is discounted a bit given the intervention of the Federal Reserve. Now, I've talked a lot about why I don't subscribe to the narrative of, oh, the Federal Reserve is, printing money and inflating the stock market. I don't think that's what's happening at all, but I do think that there's definitely some kind of impact that the Federal Reserve is having on consumer and corporate behavior, and their actions in the financial economy, I think, has definitely promoted more and more inflows into the stock market and other markets, as you can see with basically every market being extremely, for lack of a better term, inflated. And so when we take a look at this, this shows us the last 50 years, we can see that the US stock market, its valuation has kind of gone above and below gross domestic product. And since the mid 2010s, around 2015, we kind of met these two lines. And, after that, the blue line just, skyrocketed off and has not gone below the figure of GDP in a long time, really since the recovery after the financial crisis back in 2012, 2013. That's the last time that the US stock market nominally was valued at the same as GDP. And so when we look at this and we zoom this out, where are we in the current market cycle? Are we overpriced or are we underpriced? And so when we take a look at this, we zoom out, we can see that we've had several different big bear markets. And both of these, we were well over 100%. Well, at least in the dot-com bubble we were well over 100%. This was at about 142%, looks like was the highest reading. Yeah, 142%. And if you take into account the assets on the Federal Reserve balance sheet, the total market cap was 135% of GDP and the assets on the Fed's balance sheet. So that's a high figure. Now, when you look at where we are currently, this was at 200 right now, as of November 2021, this figure is at almost 210%. So it's almost just laughable at how crazy this figure has gotten. Now, a lot of people might be saying, well, the Federal Reserve is, inflating the stock market, they're, printing money and all that. Well, even if you account for all the Federal Reserve's intervention in the last year and a half, but also even in the last 10 years since the financial crisis, when they really started doing a lot of their asset buying programs, this figure still eclipses every other historical figure that's here in the last 50 years. And if you actually, if there was more data here, this would be the highest figure of all time, because the amount of intervention from the Federal Reserve, this is completely, at a record. And when you look back even to the late 60s, before stagflation, the U.S. stock market was not nearly as high above GDP as it is today. But even if you say, you want to take into account the Federal Reserve's actions, this is still more overpriced than it was back in the year 2000, before the dot-com bubble, which led to a kind of double dip bear market, or double recession, that led to negative year-over-year returns for a decade in the U.S. stock market. So this is very, very serious, and it shows just how precarious of a position we are in right now in the U.S. stock market, and it's pretty concerning. Now, if you take a look over here, and just to give us perspective of these figures, because it's like, well, so what? What are these figures? What do they really translate to? Well, when we go down here, we can look historically at what these figures kind of represent. So a ratio of under 76% is considered significantly undervalued. Between 76 and 97% is modestly undervalued. So let's check out some of these figures here and see when they were at, these levels. So we have here in the late 1970s, 1980s, we were at under 40%, under 50%, regardless of which figure you use, whether you included the Fed's balance sheet in the equation or not. And obviously this resulted in a great buying opportunity, or a great time period to buy, because this led to the late 80s and the 90s kind of expansion that had amazing returns in the stock market. And this then reversed after the valuation of the stock market got really, really high. Now, again, these kinds of figures don't tell us of when the market's going to go down. It just gives us an idea of how undervalued or overvalued the stock market is compared to GDP, which is a great baseline to have because it adjusts for the depreciation in the value of the US dollar. You know, it's constant. It's a good relationship because, you know, as you have inflation, if you want to call it, that adjusts GDP and the stock market in real terms. So it's a good baseline to have to compare it to, because you can use it over time to have a consistent kind of valuation metric. So I think this is such a cool way of viewing it, especially if you're a long-term investor looking at the big picture. If that's kind of your go-to. So anyways, this led to, let's see, under 76% here after the dot-com bubble, which ended up being a pretty good buy. That led into the housing crisis, but it didn't happen until the US stock market became over 100% of GDP. And after the financial crisis bottomed, we were at about 50%, 45% if you include the Fed's balance sheet. And so that's significantly undervalued. And so if you can see that if you actually just bought when it was undervalued here on this metric, you'd be in a pretty good place. Now, when we get into the other categories, you've got 97 to 119% being fair valued. And then you've got 119 to 140% being modestly overvalued. And then you've got the ratio being over 140% being significantly overvalued. And so this metric has continued to show extreme measurements over and over and over again, and it's just continued to go higher. So it doesn't necessarily mean that there's going to be an imminent reversal, as we can see over the last several years, that this figure has been over 140%. I think we've been at over 140% since, well, if we take into account the Fed's balance sheet, we've been over 140% since I think May of 2020. I'm trying to zoom in, here we go. Let's see. Yes, since May of 2021. Okay, for the Fed's balance sheet, yeah, since May of 2021. And so we've still seen upside in the financial market. So this doesn't mean that this is a signal of any kind of immediate reversal in stock prices, but from a long-term perspective, it can give us an idea of how undervalued, fairly valued, or overvalued the stock market is. Now, if we take into account how this site calculates its expected returns over time, given these inputs, if you take into account just the unadjusted figure, which is total Wilshire 5,000 index divided by GDP, you get an expectation of about negative 3.3% returns year over year from this current valuation. If you take into account the Fed's balance sheet being added into the denominator to give it more of a, I guess, balanced valuation, taking into account how much financial engineering has been going on, and I guess giving it the benefit of the doubt that that is actually creating substantial amounts of inflows into the stock market, you still get a significantly overvalued figure, given that it's above 140%, 153.1% to be exact. And that gives you a likely return of negative 1.5% per year from this current valuation, which is not good, obviously. And when you look into and actually read this over, it's actually pretty fascinating. And I was actually kind of laughing here. It says, we can see that during the past 5 decades, the total market cap divided by gross national product ratio has varied within a very wide range. The lowest point was at about 32.7% in the previous deep recession in July 1982, while the highest point was about 209.7% in November 2021. The market went from significantly undervalued in July 1982 to significantly overvalued in this current month, November 2021. So that's pretty wild just to read that, you know, we are literally at unprecedented levels in this metric. We can't compare this to anything other than maybe the dot-com bubble. But even that, we've already exceeded those levels. And that led to a decade-long, in a sense, from a technical standpoint, bear market, where you had negative returns year over year for 10 years. That's considered the lost decade. And a lot of people don't really want to think about that or consider that, because it's like, well, if you invested throughout the 80s and the 90s, you'd still be up and blah, blah, blah. It's like, these are big warning signals, flashing warning signals. And it's really sad that during these kinds of times where there's extreme euphoria and the market's extremely overpriced, that's when everyone gets in. And that's when the least sophisticated investors get in and end up getting really hurt because they don't know this game inside and out. So I also wanted to show this website, this article that was posted on Yahoo Finance back in May of 2020. It's like, what is the Buffett indicator? And this was right when it was becoming, it was at over 138%. It was eclipsing the figure back in eclipsing the peak of the dot-com bubble, where the valuation was at that time. Now it went up because the market went down, but also GDP went down a lot. And so the indicator was still at a high level. And this is not taking into account the Fed's balance sheet, but it gives us a good, I like these little figures here because it kind of shows you the baseline, 100% being kind of, I guess you could say, fair valued around that level. And obviously we continued higher since this article. But I wanted to read a few things. So historically, the Buffett indicator average has been around 65%. Now, that's a little bit off. Fair values between 65, what was it? I think 70 and 79%, was it? Let me see real quick. Yeah, so fair value between 97 and 119%. Maybe that's adjusted for now, but average, it's been more in the 80s, 70 to 80% range. But we've been in such an extreme bull market for, when you really look at it, the past 80 years, that these things have gotten really extreme. And you can see that by this right here. The ratio dipped below 30% several times throughout the Great Depression, and then briefly in 1982 following stagflation. The ratio peaked at 88.3% prior to the market crash in 1929. So back in 1929, which led to an extremely large bear market, a 90% stock market crash over 3 years, and the market didn't recover and make a new nominal high for like 25 years. I don't think it was till 1950 something, 55 maybe, that the market made a new high. That's 25 years. Everyone talks about, the market always bounces back. It's like, well, there are certain periods of time where the market hasn't bounced back. If you look at other indices in the world, even recently, you look at the difference between how the U.S. stock market has performed compared to the Shanghai index and the Japanese Nikkei, and a lot of these indexes haven't made. I think they've recently made highs, but they've been down in a bear market since 2007, since the financial crisis. They hadn't made highs until very recently, whereas the U.S. Stock market made a high only, 3 years later or whatnot. And so it's a totally different story when you actually widen your perspective and look at different markets, because I think it's a little bit naive to kind of look at it through rose-colored lenses, just because you've had a really good last, 5, 6, 7 decades, But anyways, that really gives you a different perspective of how extreme this bubble is when you look at this 88.3% figure preceding the 1929 crash that led to, a bear market that didn't recover in nominal terms for over 25 years, or around 25 years. And I think that really just attests to how financialized our economy is and how inclusive it is now, to where, you can have a teenager just pick up their phone, download Robinhood, and, put their paycheck into the stock market. And it's actually become a game. If you notice the trends in social media and whatnot when it comes to stocks and engaging in very risky activities, such as derivatives and stuff like that. I mean, this has become almost a culture shift towards equities and towards investing. And it's just absolutely wild. It's amazing, given that I've been, dealing with this before all of this craziness and euphoria in this area in the last year and a half. I've been around a little bit before that. And I'm very young, and I'd still consider myself, a beginner. But I feel like kind of a veteran when it comes to all these people that are just now getting into the game and think that they know what they're doing. And it's a little bit frightening, I have to say, because what we're headed for is not pretty. And we can see that because when we look at this chart right here, the market doesn't stay overvalued. It doesn't go from overvalued to modestly overvalued and then continue on up. And that's kind of the narrative right now, that most people are thinking that, what we had back in 2020, that flash crash that took place over like 6 weeks or something, that was a bear market. And that's not a bear market. It's not a bear market. The only way that you can view that as a bear market is if you subscribe to the arbitrary threshold of 20%, and that's a bear market. That's, other than that, it's not a bear market from a fundamental standpoint, from a timing standpoint, from a technical standpoint. It's just not. It was a correction within a larger correction. It was actually an impulse within a larger correction of a larger bull market going up. It was not an actual bear market, from my standpoint. So anyways, that was a little bit of a rant. I kind of got carried away there, but the point of me saying all this is that a sustainable bull market cannot begin from already overbought levels. And when we take a look back over here, this chart here, going back, let's go, we can go to this one. We go to undervalued levels and then back to overvalued levels. Then we go back to undervalued levels. Then we go back to overvalued levels. And what I expect, as we saw back in the 1970s, back in the 1920s, you had relatively different thresholds for what was considered undervalued and overvalued, given the fact that a much smaller proportion of the population was actually engaging in financial activities such as investing, trading, and buying equities. That was not as widespread of an activity as it is today. But what happened back then was that you had times where things got really overvalued, and they didn't just correct back to fair value. They go back down to valuations that are severely undervalued. And that's what we saw during the 1970s and the 1980s. We're having figures between 30 to 50%, regardless of which measurement you use, of the stock market being valued compared to GDP. And then it leads to these overvalued valuations that then correct and go back to being undervalued before going back to being overvalued. And so it's this kind of thing that happens where you have these valuations dancing basically with GDP. And sometimes they get extremely far apart, and that happens. But it's not something that I am betting on continuing to be the case, because I think just like we saw in 1929, just like we saw in the late 60s, that led to a 10-year bear market in real terms. And just like we saw back in the dot-com bubble, when we get these kinds of situations where the stock market becomes way overvalued compared to any kinds of real metrics and real values such as GDP, it does not lead to very good returns over time. And so this is more of a fundamental view of the stock market, where we are. And I think this conclusively supports the fact that we are currently in a stock market bubble. And it doesn't mean that it's going to end right away. That's why I use my technical perspective on the charts to kind of give me a sense of whether a trend is breaking or continuing or whatnot. But from a fundamental standpoint, it is definitely in a very, very precarious spot. And I'm going to leave you guys with one quote real quick that I found kind of funny from this article down here. And it said, let's see here, we'll just read this part. The Buffett indicator has been above 100, a level often considered overvalued, for roughly 8 years now. It's now been over 9 years. The only time the ratio dipped below 65 since 1995 was during the worst part of the financial crisis of 2008 and 2009, which Warren Buffett was heavily buying. You know, Berkshire Hathaway, that was a big opportunity for them, and they saw it and they recognized it. And, you know, we're probably looking at the Buffett indicator right here. And so, unfortunately, the limitations of the Buffett indicator mentioned back in 2001 the limitations Buffett mentioned back in 2001 mean the Buffett indicator is limited in its utility. The indicator isn't a sign of imminent market sell-off, as suggested by the fact that it has been historically high for several years, right? This is just giving you an idea of where the valuation is. It doesn't mean that it's going to result in any kind of correction or anything like that. As we can see, valuations can be crazy for extremely long periods of time, as long as people are still optimistic and expectations are still high and people are buying into that. So how should investors think about a Buffett indicator currently making an all-time high? Again, this is back in May of 2020. Buffett addressed the indicator peak back in 2001. So this peak right here, over here, and we can see it right here. This peak back in 2001 that led to the dot-com bubble being bursted. Nearly 2 years ago, the ratio rose to an unprecedented level. That should have been a very strong warning signal, said Warren Buffett. So I think we're at a very similar state. I've been hearing things about, you know, Warren Buffett saying that, oh, you know, the tech sector is not in a bubble, but I'm still not buying. That kind of sentiment. It's like, I don't really care what people say. I really care more about actions and what people do. And I think that reflects a much more accurate sense of what they really feel. And I think we are in an indisputable bubble that is going to wreak financial havoc when it finally bursts. And I'm going to be keeping a very close eye on that on this channel, especially from a technical standpoint. But I think looking at it from this kind of fundamental standpoint can include more people in the conversation, because it's so simplistic and so intuitive. It just makes sense, right? And it's something that we have a lot of data for, and we can track it over time to give us a sense of, well, compared to these different kinds of market cycles and these different peaks, you know, where are we right now? Well, we are in the process of forming a peak that has never been seen before, that has eclipsed every other metric in history, and will likely end in the same way that every other financial market bubble has ended. And that's been in a very severe bear market driven by fear and pessimism. So that is my perspective. I think we are unequivocally in a bubble, and I'm going to do my best to share other information that will give you guys a different perspective, and hopefully help you be able to position yourself in an optimal way and protect yourself financially. So again, this is not any advice or anything like that. It's just me sharing some information that I find very interesting and meaningful and valuable as well. So I would love to hear you guys' perspectives about these different metrics and my perspective, and I'd love to hear where you think we are in the market cycle and how extreme you think these metrics can still become as we continue to chart this crazy market cycle. Would love to hear it. Thanks so much, and I'll see you guys next time.